Welcome to Technical Trading, Part 1. This is a two-part webinar series. The next part's going to be run next week at Thursday at 1 p.m. A lot of what we're going to be teaching tonight is going to be applied in the live market next Thursday. So what that means, what I want you to do is have a think of a few stocks that you'd like us to cover. It doesn't matter if they're American or Australian stocks. You know, it's going to be easier to analyze Australian stocks because that's kind of our backyard. We know a little bit more about them. You know, we've got a bit more of a feel for the Australian market. But at the end of the day, what I'm covering in this webcast can be applied to basically any market. So this webcast focus is on technical trading, right? So it's focused on technical analysis. Technical analysis, as I'm going to get into a little bit more, is really something that you can apply to any market that you choose to approach or any instrument that you choose to trade. And that's how important this is. So make sure that you listen in, write down your notes. And if you've got any questions, like I said, please feel free to type them in. If you're experiencing any technical issues, if I'm just some guy waving my hands on the screen and you can't hear what's coming out of my mouth, or you drop out at some point, feel free to call the number on your screen. Hopefully someone will pick up and be able to assist you with any problems. But let's get stuck into it. So you might be wondering who we are. Just a quick introduction. My name is Karo. I've been with Traders Circle for about 10 years now. And one of my main jobs here is to execute orders for my clients. So people will call up, ask advice on any particular stock or any position that they're in. And I'm very happy to give them, you know, some direction in that area. If they want to execute an order, I can place the trades in the market for them, but we also provide online execution, of course, as well. Trader Circle's been around for since 2005, so quite a long time, and we specialize in support. Basically, we're traders who want to support other traders. So we don't want to trade for you. You don't just give us your money and then we play the market for you. What we want to do is empower you as a trader and then support you, right? And that comes through the form of education. It comes through the form of personal trainers, full service brokerage. So like I said, calling up and getting advice on the positions that you're in, getting trade ideas from us, basically the full works in order for you to help tackle this market and hopefully profit from it. It's a great time to kind of be talking at the moment. I mean, it depends how you look at it. From a trading perspective, it's a great time because we love volatility. We love big movements. It's when kind of things are a little bit quiet, we kind of fall asleep at our desks and it's a bit quiet in here. But when things are moving, you know, there's some great trading opportunities, right? So yeah, right now is kind of a good time to be learning this type of stuff. Right? The market's corrected technically. It recently corrected too. And so hopefully all of you are writing, you know, your shopping list, you know, your wish list. Instead of sending it to Santa Claus, you can send it to us or the ASX and we can see how we go. And again, I will reiterate, if there's any stocks you want me to look at, what we're going to do, I might touch on them tonight, depending on how time goes. But we will largely cover that in the second part webinar. So even if you're not able to make the 1 o'clock session next Thursday, type in those stocks that you want us to look at, and we will be sure to give you an opinion. We'll mainly focus on technical analysis, but we might touch on fundamentals. And if you're not able to make the 1 o'clock session, because it's during the workday, you're welcome to watch the recording, and the stock will be, you can watch how we address the stock then. All right. Emerald Financial, by the way, I digress. Emerald Financial is the sister company. Emerald Financial focuses a little bit more on fundamentals, focuses a little bit more on investing, a little bit more on the longer term, right? But you'll see me touch on Emerald Financial a little bit because I do use it for the fundamental analysis, just a little bit, okay? All right. Just keep in mind that any advice contained in this presentation is general only, which means it's not tailored to your personal circumstances, and you therefore need to decide for yourself as to whether it's appropriate to you. Now, I like to kind of kick off any education with this particular slide and just talk about what it is that you need to learn in order to be a successful trader, right? I think no matter what path you choose, really what book you read, what webcast you watch, who you kind of talk to, I think ultimately this is the direction that people need to focus their efforts in when it comes to learning how to trade. You need to be able to pick direction, which is really what the majority of this webcast is going to be about. You need to have a few strategies in your arsenal in order to trade different market conditions. And of course, you need to have good risk management, because at the end of the day, you're not going to get every trade right. And you need to have a few contingency plans, and you need to make sure that you don't give up all the profits that you've made on a handful of bad trades, right? So all those three things, if you can become good at picking direction, strategy, and risk management, then, you know, in theory, you should be a great trader, right? But it's easier said than done. What kind of brings them all together is a set of trading rules. And I think this is arguably the most important thing when it comes to trading, because trading rules, what they do is they allow you to kind of take everything that's out there right now and everything that's out there that will be, right? So you've got technical analysis, fundamental analysis, you've got Russia invading Ukraine at the moment, you've got Wall Street bets, which is highly influential, you've got American politics, which has a heavy influence on global markets, you've got the coronavirus, which is throwing things into a spin, the Federal Reserve and money printing, inflation, interest rates. You've got all these different news sources creating almost tabloid-like articles about what's going on, let's be honest. There's a lot of information to digest, right? And what rules do is they allow you to funnel all that information. You can see I've got some kind of silly pictures there. All that information into a step-by-step trading system, okay? Now, everyone has a different trading system. There's not one thing that works, as I'm sure you're all very aware. I think the key thing here is to make sure that you just have one. Sometimes they can be quite loose. Sometimes they can be really tight, really strict. So you kind of need like the stars to align. Venus needs to be in retrograde and it needs to be April or something like this, right? Something really obscure and tight focused. But at the end of the day, as long as you've got a set of trading rules, I think that's one of the key takeaways from tonight's webcast, okay? What they allow you, the reason why they're so important is they ultimately keep you disciplined, right? Because it's, you know, trading is largely about psychology. If you're a beginner trader, that probably doesn't resonate with you. But if you're an experienced trader or an investor, that probably does resonate with you. At the end of the day, you do so many trades over your lifetime, you'll find that basically it just comes down, a lot of it just comes down to psychology. And so trading rules kind of help alleviate that a little bit. It kind of keeps you on track. It keeps you disciplined. It helps reduce your stress because you're not making decisions that are emotional. So if you do have a bad trade, you don't have to be like, oh, why did that happen? And oh, I put too much money on it, or what can I learn from this? And you know, it helps kind of keep things on track, really. It helps simplify decision making, and hopefully the reason why I can do this is because your set of trading rules, your approach, is logical, obviously, and has been tested as well. So now that we've covered that, let's get stuck into kind of the guts of tonight. We are going to start fairly basic. This is stuff that you guys probably already know. You've got two main types of analysis. You've got fundamental analysis and you've got technical analysis, right? Both are important, but you'll find that both lend themselves towards a different style, right? A little bit more heavily focused depending on what you're doing. So I've mentioned it before. Technical analysis for us is much more important when it comes to shorter term styles of trading. But fundamental analysis, on the other hand, is probably a lot more important when it comes to longer term investing, right? We find that fundamentals play out over the longer term, which is why they're important for investing. And we find technicals are much more reliable in the shorter term. So does that mean you do one or the other? No, but it means that you should be leaning on one a lot more, if that makes sense. And as a beginner, you might not want to kind of concern yourself with both, because what you should try and do is take all that information that's out there, and if you can, try to keep it simple, right? Again, easier said than done. Now, with our education, we provide you a set of trading rules, right? It's trading rules that we've evolved over time that we think are a great way for beginners to learn, right? It sets a really strong foundation. And then as you develop your skills, as you gain experience, then you can alter those rules to suit you as a person, or suit your trading style, suit your risk tolerance. But that's hard to do as a beginner, because at the end of the day, you don't really know what you're doing, and you can't evolve or make your own trading rules unless you've got a lot of money and you've got a lot of time, and you can kind of go through trial and error. Hopefully that makes sense. Now, the main differences between technical and fundamental analysis is that technical analysis focuses mainly on previous price data in order to predict future price movements, right? You can tell that's a line I've practiced. What that essentially means is that you look at how the stock's traded over time, and then you use those patterns to try and predict how it's going to trade in the future. And the best way of doing that is by looking at charts. Does that make sense? So that's what we're going to do tonight. We're going to mainly be looking at charts and how to understand charts. Fundamental analysis, on the other hand, is, I would say, almost everything else, right? So you're looking at how profitable the company is, how much revenue it brings in, the market it operates in, how much market share it has, is it growing, does it offer a good dividend? You look at the reports it releases once or twice a year, and you look at its forward guidance to see how much money they think they're going to make in the future. Then you compare that to its share price, you look at its debt levels. It's the fundamentals of a company that you're looking at. You can extend to things like the company board. You can extend to the main operators, other forces in the market that are pushing it. These are all fundamental things to do with the company that affect its share price, right? So that's fundamentals. And the world of fundamentals can get really crazy really quickly. And so what people do is they try and focus on the things that they think are the most important thing, and then translate that into the share price and see if it's undervalued or not. Basically, it's not easy, and everyone's kind of got their own way. Just like technical analysis, everyone's kind of got their own way of doing things. Emerald Equities, like Emerald Financial, what we do in that area of the business is we try to bring all that fundamental stuff together, and we try to develop it. We'll try to give it to you in a scoring system, and I'll run through that a little bit tonight. That's, again, not really the main focus of the webinar tonight. So getting back to technicals, technical analysis is, again, better for short-term trading. It's focused on charts, i.e. previous price action. And the basic principles are trends and counter trends, support and resistance levels, technical patterns, entry and exit signals, and then mathematical indicators, also known as technical indicators. Now, a good analogy for this is technical analysis is similar to painting a picture. I wrote an article on this many years ago, and you can still find it. It's not my best writing because it was many years ago, but the point still stands. Technical analysis is like painting a picture. It's not until you've applied all these kind of principles does the image become clear to us, right? And the image tells us a story, and hopefully it tells us where the stock's going, right? Because that's the whole point. So it's not until you've applied your trends and your counter trends, it's not until you applied the support and resistance levels, until you've identified some technical patterns, looked for your entry and exit signals, and then confirmed with your technical indicators, do you get like a strong indication of where the stock is going? Okay, does that make sense? If it doesn't make sense, hopefully it will by the end of the webcast. So this is what a chart, one of my charts looks like. This is about a month or two old, or a few months old. I thought it was kind of cool because there's a lot going on, right? I mean, as a beginner, if you're looking at this, it's probably a little bit confusing as to what all that means, right? But hopefully by the end of the webcast, you'll have a, at least some of it will make sense, hopefully, right? And it can, by the way, it can get way crazy in this. I've seen charts get absolutely wild, and this is kind of dumbed down for the webcast a little bit. There's more you can kind of add on top of it, but that doesn't mean you make money. See, that's what's interesting. It's not, it's not the more you know about stuff that makes you money, which is what's interesting. It's sometimes keeping it very simple and having, again, a clear set of rules that actually helps you profit from the market. That's what's interesting. So what we're going to do is we're going to go through a step-by-step process. right? Almost similar to a set of trading rules, not all the secret herbs and spices, of course, but giving you a bit of a kickoff, right? Something that if you decide to go and learn this stuff, hopefully gives you a bit of direction, right? You can learn it through us, but if you go through another provider, at least you have a bit of a checklist of the things that you should learn, right? So the first thing to identify is arguably the easiest thing to identify, which is the market range and the trend, right? So what we want to do is analyzing a chart here. By the way, it's probably important to let you know that, where's my mouse? Each of these bars represents 1 day of trading. Okay, again, you probably already know this. This information can be displayed as candlestick charts, which are very popular. It's the same information. It can be displayed as a line chart, which represents about half the information. It just kind of shows you the close of each day. And those are the, and this is what you call an OHLC, or open, high, low, and close chart, right? Shows exactly the same information as a candlestick chart and a little bit more information than a line chart, right? It's just what I learned to use, and it's just my preference, right? If you prefer candlesticks, by all means, I would definitely choose one of those two though over a line chart if that's what you're used to looking, because lines don't give you as much information, really. So again, each day represents a bar of trading. The price range is the y-axis on the right-hand side. You can see here. And I haven't got a timestamp, but usually, time goes from left to right, and that's the x-axis. Okay. So the first thing you want to do is draw in your trend lines. Now, another name for a trend line is the support level, but we don't use the word support. We use the word trend because support can also be horizontal, and I'll go through that in a moment. But the reason why we use the word support is because, as you can see, each time the stock returns to this line, it bounces, doesn't it? I mean, you're almost creating like a rule, right? You're saying, okay, every time so far, the stock has returned to this trend line, it has bounced higher. Okay, well then, if it returns to that trend line in the future, maybe that means it's going to bounce again, right? Because it has every other time. Right? Now, obviously, it's not going to do that 100% of the time, right? We wouldn't be having this conversation. But it's just one piece of the puzzle that hopefully helps start to develop an image, like I said. So we define our market range, right? We go, okay, the stock seems to be trading between these 2 points, right? And again, this is the opposite to a support, it's a resistance. So if the stock ever touches it, it seems to come back down again, right? Here as well, bounce down, but it also gives us a bit of a market range, doesn't it? Now, you're not going to be able to draw this on every stock. There's a reason why I chose this chart, is because it looks kind of pretty, right? It's an easy way to explain the elements that I'm going to run through tonight. But I could, we can pick any stock and apply these analysis, which is what we're going to do next Thursday. One thing to note here is that you're better off trading with the trend. So if the stock is uptrending, right, because it starts down here and finishes up here, if the stock is uptrending, you're generally better off doing bullish trades. If the stock was downtrending, you either want to do bearish trades, and you can do that through the use of derivatives such as mini warrants or options, which is what we like to trade. Or alternatively, you just don't trade the stock, right? Trying to pick a bottom can be dangerous, to say the least. Catching a falling dagger is a common expression because you can get your hands and your fingers cut off. So you just got to be mindful of that. The other common saying is that if you try to pick bottom, you can get smelly fingers, right? a bit of an old saying as well. So if the stock's downtrending, either don't trade it or consider using bearish strategies if you know how to use them. Now that we've defined the trend, what we want to do is identify any major levels of resistance and support, right? This is kind of like developing a market range as well. So for example, you can see here, there's a clear level of resistance. So the stock has been traveling up, but each time it's gotten to this line here, so this particular price point, call it 78.50, right? The stock has turned around. It turned around a few times here. So it tried to get through there, came down, tried to get through here again. I mean, it even tried there, arguably. It went up and came down intraday. Went up, it stuck its head through, said hello, came back down, didn't want to commit, did it here, and then came back down again. So this seems to be a bit of a level that the stock just didn't want to get through for a while. Now, admittedly, that day there, or today, it did, because that's today's bar, right? So that's important to recognize. It's important to recognize that that was a prominent level that caused selling for the market. Another simple way of saying that, it's a resistance level. The next thing that you want to do is you want to identify any kind of patterns and breakouts. So there's a plethora of patterns that you can go and research. We teach them, obviously, in our courses. They just kind of help identify and develop the narrative around what the stock's doing, right? Another way of saying that would be you're adding another artistic element that makes the image clearer, going back to that old analogy, right? So you can see the stock was traveling higher, right? Traveling higher. It hit this level of resistance that it didn't want to go through, and it started to be forced into the point of a triangle pattern. So that line there, that resistance level, in conjunction with the uptrend line, that level there, that line there, created a triangle pattern. Now, triangle patterns appear everywhere. There's a lot of different triangle patterns. There's pennant patterns, there's descending triangles. In this circumstance, it's called an ascending triangle, right? Because it's ascending, right? It's going up, and it's hit a clear level of resistance, and it does not want to get through it. But one of them has to break, right? It's not possible for one of those lines not to break. It's either going to be the uptrend line that breaks, or it's going to be the resistance level that breaks. More often than not, the uptrend line will win, right? More often than not, the trend line will win. And that's, I would say, self-evident. And I would say it's a bit of a no-duh kind of statement, but it's important to remember. One of the reasons why that trading with the trend is, you're better off doing that than not, okay? Especially as a beginner. Don't try to snipe and anti-trend kind of trades. Don't get stuck into that as a beginner. So you can see on today's bar, which is that bar there, I know it's a little bit small. Hopefully you got good eyes. You can see on today's bar that it broke that triangle pattern today, didn't it? No? You can see it pushed through that resistance and it went, all right, we're on. You know what I mean? And that shows confidence in the stock. It shows that it's ready to go. And that can be what you call a bit of an entry signal. So I'm a bit behind my slides, So that's a bit of an entry signal, right? This idea that the stock has finally pushed through that triangle pattern. It's finally broken that triangle pattern and pushed through that resistance. And it shows buying power behind the stock. And from a trading perspective, that might give us an opportunity to do a quick bullish trade. The thing is, though, and maybe you've clued into this, is that there's also another pattern going on here. It was the first pattern to present itself, and it's called an ascending channel. So there's an uptrend line. There's an ascending resistance level as well. And what that does is it ping-pongs the stock between them, creating an ascending channel. So it's a channel that's rising, right? What that means, though, it actually gives us a bit of a price target, though, doesn't it? Just a little bit. I mean, it's not, I wouldn't swear by it. I won't die on that hill. But it gives you a bit of a price target. You can go, okay, well, yes, it's pushed through and broken that ascending triangle, which shows good buying power. But it also gives a bit of a target, which is up here, doesn't it? Because every time the stock has reached that resistance level, it's turned around. So if we are going to trade this, then we have to keep in mind, okay, what type of trade am I going to do? Well, I like short-term trading. That's kind of the trading that I'm in, which means I do want to be out by that point, right? I'm just going to do a bullish trade. I'm going to utilize an option or a warrant for a little bit of leverage so that I don't have to put a lot of money in. And I'm just going to make money to that point there. That's reasonable. That's kind of what we teach our clients. But at the same time, you could also just buy a mini warrant along, or you could just buy the stock, right? Nice and simple. And just hold it for as long as that uptrend line holds, right? It's just that that's a good entry signal. And so this is where you can kind of marry up technicals with fundamentals a little bit. You could have a longer term view of the stock trade it whilst the trend holds, and not worry too much about that resistance. It might break through, it might pull back, but as long as it's ascending, then I guess you're making money, right? Which can be good, you know, obviously as an investment tool as well. So this is where technical analysis can step into the realm of investing, because it can help you time your entries a little bit better, right? It can also show you what to expect in the short term, so that if things do pull back, maybe you're not so worried. Does that make sense? Okay, hopefully it does. Now, the final thing you do, and I do mean that, this is the final thing that you do, is you confirm with technical indicators. All right, now you can see down the bottom here, I've got this like squiggly line. It's a red and blue line. And you can, if you just look at it for a little bit of time, you can kind of clue in as to what it's doing, right? It's following, it's kind of mimicking the price action a little bit, right? And you might think, well, what, you know, so what, right? And I'll explain so what. So what the stochastics, this is called the stochastic oscillator, right? I mean, why? I don't know why. They have to make it sound complicated, don't they? I mean, that's technically what it is. What the stochastic oscillators do, I didn't mean to push that, is they show momentum. So as the stock, see how these two lines are widening like this? It means that the stock's got some power behind it, which is good because you kind of want to get in on some strength. The crossover shows a change in direction. So you'll notice that crossover aligns with the change in direction here, right? It also shows when the stock is kind of overbought and oversold. So you can see when the stock, can you see these like dotted lines here? These dotted lines represent oversold and overbought areas. So that's overbought up here and that's oversold down here, okay? So if the stock is oversold, like you can see it was here, it tends to pull back. So it's not if the stock is overbought, it tends to pull back, so it's not overbought anymore. You can see it did it there a little bit, started pulling back up here. You can see it stayed overbought for quite some time because there was a bit more strength, but then it does correct itself and come back in. And you can see it does it there as well. Equally, if the stock starts to look oversold, you know, some buying power comes in. Now, these are short-term stochastics, so they're not going to, again, they're not very useful for longer-term projections. You can get longer-term stochastics as well, but they're kind of a cool little tool, just simply for that reason. Once you get a bit more experience and you get a bit more knowledge, you'll notice that the stochastics are also good for divergence. So they can kind of anticipate a bit of a bullish run or a bearish run prior to it happening, even though it is a lagging indicator, which means it shows what's already happened slightly, okay? The other thing, they like kind of give direction. So if they're pointing up, it's a bit more of a bullish indication. There's a reason why this is at the end of the analysis. The reason why I'm stressing that right now is because they're kind of cool, right? A bit of like a cheat sheet. People who are new fall into the trap of looking at the stochastics first, and that's not particularly helpful, because what it does is it puts a biasness in your brain. Remember how I was saying that trading is all psychology? This is where it comes into it a little bit. If you start with technical indicators, you actually start to have biasness, and that's the lens that you will look at the market through, right? And that's not good, because there's a lot of things that can affect your psychology. Okay, if you've had a bad day, that can affect your psychology. You know, if you've just had a win, that can. The most danger you'll ever be in as a trader is if you've had a few wins in a row. Trust me. So you want to try and reduce that as much as possible. And what these really cool indicators that assist us traders, they can start to look attractive as a tool to analyze the stock, and you can just start to lead with them. So try to avoid that if you can. Another really cool type of indicator that is very, very common are the moving averages. So I've got a few different moving averages here. I've got the 200-day, which is the red line. You can make them whatever color you want. I mean, they could be purple, pink, whatever, right? Mine's just red. And that shows what the stock, the average price the stock has traded at over the past 200 days. I've got the blue line, which is the 100-day moving average that shows what the stock has been doing over the past 100 days. And I've got the 50-day moving average, which is the green line. And the green line shows what the stock, the average price that it's traded at over the past 50 days, right? These are awesome tools. We don't teach them typically to beginners because we don't want to overload you with information. But it's something that I like to use. It's something that a few of my colleagues like to use, but some people don't like them, which is totally fair enough, right? You've got to find a trading system that works for you. And sometimes less is more, right? As famously said. The reason why I want to show the moving averages again is because I like them, but you can see they also kind of show support levels, right? So have I got little things here? Yeah. So the green line is, again, the 50-day, and you can see it's actually supporting the stock. Every time the stock retreats to the 50-day moving average, it seems to bounce. So it bounced here, it bounced here, it bounced here, and it bounced these few times as well. So every time the stock seems to return to the 50-day moving average, investors start to look at the stock as a cheap buy. I mean, it doesn't need to be any more complicated than that. And you can go like deep into this analysis. Like you can go like tinfoil hat, down a rabbit hole. You end up in Alice in Wonderland type scenarios where you can really analyze the hell out of this stuff, right? As I'm sure you're aware. But honestly, when it comes to moving averages, I find they're a bit of a magnet. So I find the stocks tend to return to them. I find that they're can be very like buoyant. So when a stock goes below them, unless there's strong power behind the stock, unless there's strong forces behind the stock, it usually kind of bounces back up. The analogy I use is like forcing a balloon underwater. If you force a balloon underwater, it's either going to pop back up, right? Or it's just going to pop and like disappear. And I find stocks kind of do that with moving averages. You can force the stock below the moving average, but it should generally just pop back up. Or there's so much force behind the stock going down that it just, the balloon's gone and it just sinks. Do you know what I mean? And yeah, so that's one thing to consider. But I mean, I wouldn't worry about that too much. At the end of the day, one thing you can do as a beginner is just put the 50-day moving average on there if you wanted to, and just watch how the stock uses support or resistance, etc. I like the 100 and 200 as well. It's up to you. You can use the 50 in conjunction with the 200. It's called a death cross and a golden cross. That's starting to get into other little patterns there that you're welcome to research. But people use the 7 as well. There's a whole bunch of moving averages that you can use to assist in your analysis. By the way, the stochastics are kind of moving averages anyway, right? They're just shorter term ones. So let's summarize what we've run through. The first thing that we did was we ran through the trend. We ran through the trading range, right? The second thing that we did was we applied any key levels of resistance and support. And I do want to reiterate that you're looking for key levels, right? You're looking for levels that are prominent. So things that have acted with consistency in the past. Now, support levels, every resistance level almost always breaks, right? Because stocks tend to go up, and if it doesn't break, that means the stock dies, right? It's a bit of a controversial statement, but my point is that support and resistance levels can break, because of course they can. But what you're looking for ones that have consistently held before. Support can also become resistance, right? So it's just a word that we use in order to describe something. If the share price is above that key level, it's a support level because it'll support the stock from falling. If that level is above the share price, it's a resistance level because it'll resist against the stock rising. So it's just a language thing. Resistance and support swap roles is my point. So you're looking for key levels that have bounced each time because it'll give you a little bit more confidence in the future to when the share price approaches it or acting as a price target, right? So that's another thing to keep in mind. Once you've identified your key levels of resistance and support, you've drawn your trend lines, your counter trend lines. Once you've got all your lines on the page, what you want to do is see if there's any patterns there. Are there triangle patterns? Is there an ascending channel happening? Is there a flag pattern? There's a lot of different types of patterns that you can identify using those lines. Just again, to build a narrative around what the stock is doing, just to help that image become clearer. What's the story here? Once you've got that idea, you don't just want to enter the trade. Now, when it comes to longer term investing, it's probably less important. But when it comes to trading, you do want to time your entries as best you can, because at the end of the day, and again, if you've got some experience, you'll understand where I'm coming from here. At the end of the day, if you've traded, you'll find that quite often you can be right, just mistimed. I mean, so much so that a broken clock is right twice a day, right? You have perma bulls that'll tell you that they're right. What they don't tell you is how many times the market's been bearish whilst they're trying to be right. Equally, you've got doomsday perma bears, people who are always calling that the sky is falling, right? Always that the market crashes around the corner, and they'll eventually be right too, right? So I'm not trying to necessarily go down that path, but what I'm trying to say is that you could believe that the stock is going to go up, but you might just be a week late or 2 weeks late, something like that. You might, mistime things. Entry signals can help reduce that a little bit. You know what I mean? So they are important. They can kind of tell you when to pull the trigger. The final thing that you want to do is confirm with your indicators. Again, I've reiterated, the indicators are great. They're a little bit of a cheat sheet. Popular indicators are things like RSI, stochastics, MACD is a very popular one, moving averages, Bollinger Bands. I don't mind how many you use, but I think that ultimately, if you start to use too many, you'll start getting conflicting signals, and that can lead to analysis paralysis, where you just don't end up trading because you just got too much conflicting data. But look, it's each to their own, right? The only other final thing that you might want to do is just consider your fundamentals. Again, it's not really the focus of tonight. I will touch on it, right? I'll just touch on it. It's up to you how much you kind of take into account. As a beginner, I probably wouldn't even bother, because you should really be focusing your efforts on technicals. But if you're a bit of an old hat, you've got some experience, then this might resonate with you a little bit. So in terms of things that you can just do straight away in terms of fundamentals, is just check for reporting. Just always be aware of when things are going to release their earnings update, because it can throw the stock into wild moves. Sometimes they don't make any sense as well. Like, you could have a really good report, but then the stock falls because it just wasn't good enough, or it's already been priced in. Equally, you can have bad reports where it was like, poof, wasn't as bad as we thought, better buy this stock. And you never know how a stock's going to report, right? I mean, unless you've got some, secret inside information, which you shouldn't be trading anyway, then you don't know how the report's going to go. You might have an idea, but you don't know. So just be aware of when stocks are reporting and when they're going ex-dividend, because when a stock goes ex-dividend, it must fall by the dividend. That you don't want to get caught with your pants down, basically, right? The other thing that you can do is do a bit of quick checking, right, with fundamentals. Again, the world of fundamentals is complex. There's a lot of ways to interpret these numbers, how much money a company, how much a company earns, how does that translate into share price, right? It can be difficult. So what we do is we have a quick scoring system, and we use Emerald Equities for this. emeraldequities.com.au, go check it out. If you're a bit more of an investor, if this technical stuff is, kind of cool, but it's not really really what you're interested in, or if you want to get your head around fundamentals, Emerald Equities is a great website which is designed to help you look at stocks quickly and analyze where they're at, right? So we've done a deep dive into fundamentals of the companies on the ASX, as well as in American markets and other markets. And we've put together a very simple way of checking them. So for example, Zip is another buy now, pay later that I'm sure all of you are very aware about. And Zip got some hype around it. So I've kind of chosen it tonight. I get calls every now and then asking, like, what's the deal with Zip? Like, is it a good stock? Should I buy it? Should I sell the stock that I'm in? look at what Afterpay did. So maybe Zip will too. I get a lot of these types of calls. It's something that I'm sure all of you have wondered, including myself. Is there some value there? And you can see the Emerald scoring system has given us a bit of an idea. So a lot of analysts put it as a buy, right? That's a consensus. It gives you how many analysts are part of that buy system. So it's not just one dude sitting at his computer going, yep, Zip's a buy. There's 14 people on average who say that it's a buy, right? So that gives you a little bit of confidence. Gives you a bit of a mean price that you can compare it to. You can go, okay, well, Zip's trading at this particular price. This is the average price that the brokers reckon it's going to. Ooh, is there an opportunity there, or is it going to fall? You get my point. And then you have our Emerald scoring. And I think this is so robust that this is where a lot of your faith should lie, right? It tells you the dividend score, which is obviously 0 because it doesn't pay a div. It's a growth stock. Tells you the quality of the stock, which is very small. It's got no price momentum because it's falling. It's a mature stock, so it's maturity-wise, it's okay, right? And then you can see the other scores there. How is it an all-weather? No, it certainly isn't. It's got terrible credit. It's got poor earnings, and right now it's got poor growth. So the Emerald score is a measly 2 out of 100. Does that mean the stock can't rise? No, the stock should certainly go up. This is just an average score, right? And I'll give you an example of how it's just a score, right? This is the chart. This is the share price performance, the blue line, versus our scoring. So our scoring has always been, I would say, fairly weak for Zip. Could you have made money on the way up? Certainly, you absolutely could have. If you've gotten behind the stock, then awesome, right? So should our scoring be the only analysis you do? No, obviously not. You can still make money on these stocks. Like, I'm not trying to poo-poo them, right? But the share price we found over time caught up with our scoring. So from a trader's perspective, should you take into fundamentals? Sure. But does the fundamentals affect the short-term share price? Not really, right? That's a very contentious statement. People might be, talking about how that's not true. But I think this kind of proves it a little bit, right? There's evidence to suggest that the short-term share price doesn't really listen to the fundamentals. The fundamentals have never been too crash hot, but there's certainly been times where the stock has gone up and you would have made money, right? But we find that, again, technicals play it over a longer period of time. And that's why when it comes to trading, we lean a lot more heavily on technicals. Now, if you'd like access to the scoring system, just jump on Emerald Equities, have a look around, sign up. I think we've got like a 50% discount on the subscription right now. It's not really, again, the focus of this webcast, but it's worth mentioning because if I ever consider trading something, I'll just do a quick check on how that stock scores, and just to keep that in mind. But again, it doesn't really affect the short term. All right, so we've got an idea. There's a question, which is what software are you using here? I'm using PowerPoint, right? I know that was a smart ass answer, right? Yeah, I use the charting system that I use is, let's bring it up. You see that? This is the charting software I use, or one of them. I've got 2. This is the one that I suggest to my clients because it's cheap and it's simple. I can link their trading account to it so that they can trade online. The other software I use is a more robust version of Iris. It's very expensive and allows me as a professional broker in order to transact things quickly, get quotes, do a lot of different functions, etc. So this piece of software here is great for charting. It's got live data if you want it. It's got quote boxes on the left-hand side. Yeah, I would say it's got a lot of the stuff that, in fact, I'll change that. It's got everything that you need as a beginner. Right. You can do your technical analysis. You can draw lines. You can see I've got squiggly lines everywhere. It's all fully customizable. You've got watch lists that you can have. It gives you all the information you kind of need. So this is Iris Viewpoint. If you sign up with us and you do some of our education, we give you this for free, right? If you do a certain amount of trades each month, you get it for free. Otherwise, it costs like $100 a month. Okay. Anyway, hopefully that answers your question, Wendy. No problem. But it's pretty run of the mill. All right, back to the presentation. Wait, that's not it. Right. Okay, so remember how I said there was 3 things that you kind of need to be good at in order to be a successful trader? The first one was picking direction, which I think we've covered lightly today. The second thing is to understand what type of strategies you're employing through instruments and what type of markets you're trading. It's something that can be overlooked as a beginner, but I think it's worth your consideration. You're welcome to obviously apply what we've learned tonight by trading stock. Sometimes you can trade micro caps, you can trade mid caps, you can trade blue chips, you can trade Australian markets, you can trade the US, whatever you want, right? Stocks are fairly standard. Your only strategy with stocks, though, tend to be buy low and sell high, which is a great strategy when markets are rising. And it's a good strategy once markets have corrected, but it can be a rubbish strategy when things are looking kind of scary, right? Like at the moment, I mean, US futures were down like 800 points in the Dow when the market closed today. So, you know, that's a great trading opportunity if you've got other strategies under your belt. But it can be kind of scary when buy low and sell high is the only thing that you've got in your arsenal. As a beginner, that's fine though, don't get me wrong. The other things that you might want to consider trading are mini shorts, mini longs. They're good for, or they're also warrants, right? Another name for them is warrants. You can trade them through the ASX. You know, they're a great instrument. You know, our clients learn about them because they provide leverage, which means you can use less money to make more money, right? That obviously means you can lose more money too. That's the other side of the coin. But it just allows you to put up less capital, basically, which is great because, you know, why would you put 20 grand on something when you could just put 3 grand on it or 4 grand, right? So they provide leverage. You can trade bullish strategies as well as bearish. So if the market is falling, you can take advantage of that through mini warrants. They're capped risk as well. So no infinite risk, no further margin calls, none of that craziness. You're not going to have someone knocking on your door or anything. You can't screw up in that way. They have inbuilt stops. You can trade them on 200 different stock. You can trade them on some overseas indices. You can trade them on some currencies as well. You can do that all through the ASX, which is important, by the way, because trading things through the ASX means that they're regulated. If something goes wrong, you have some kind of recourse. You know what I mean? Whereas, you know, you trade something that's overseas, well, you know, that's not really the government's jurisdiction, and you know, it can kind of be like, I compare that to CFDs. CFD providers, because it's custodial, what'll happen is that sometimes a CFD company will go under. A few years ago, Halifax went under, and it took like everyone's money with it. And that's not a great position to be in sometimes at all. Whereas mini warrants, that can't happen, right? Anyway, so with the other one that you can trade is options. We really like options. Options are rad. We run a course on options. We don't teach them to beginners though. Options are something that you'd learn after you've learned how to pick direction and how to manage your risk, right? Those 2 things are very important when it comes to options, because options are the most flexible instrument you can trade, right? You can trade bullish strategies, bearish strategies. You can do sideways moving strategies, which our market loves to do. You can do strategies that make money if the stock goes up a lot or down a lot, right? So bullish and bearish strategies for options trading. Those are really good around reporting, because with reporting, you don't know if the stock's going to go up or not, right? You could go down. And during reporting, quite often the stock can move percentages at a time, like 3, 4, 5, 10, 20%, right? You can do an options trade on some of those stocks where you make money as long as it moves. It has to go up a lot or down a lot. And what is a lot? Well, it's different for each stock, but my rule of thumb is about 5%. So as long as the stock moves about 5%, you're probably going to make money if you set it up right. And that's where that's where we kind of come in. There's also option strategies that you can use in conjunction with your portfolio. Famous ones are covered calls or cash covered puts. Buy right strategies where you buy the stock and sell a call against it. These are good strategies for increasing the yield on some of your blue chip shares. If you have a share portfolio that you're managing, if some of them are blue chip, like BHP, CBA, like kind of your classic household names, I'd encourage you to go look at covered call strategies. We teach it. It's a good arm's length kind of strategy that is like a bit of a halfway house between investing and trading. So it's something to have a look at. You can also use them for hedging as well against market falls, like insurance. Forex is another popular one. It's a very large market. It was like the crypto before the crypto. And then you have crypto, which is the new kid on the block with his Ferrari, playing loud and obnoxious music, not really caring what anyone thinks, giving the finger to world governments. It's the wild, wild west at the moment. Yeah, I mean, we can talk about cryptos later for sure. Risk management is the final piece of the puzzle. I don't want to get stuck here, but obviously you need to manage your risk, right? Diversification is a good way as a beginner to kind of, I mean, that's a bit of a no-doy again. Don't have all your eggs in one basket. Introduce things like stop loss and exit signals. Be aware of how much you're making and how much you're losing at certain points just before you enter the trade. And have a few contingency plans, a few repair strategies. Averaging down is an example of that. These types of things. Yep. All right. So we're getting towards the end of the presentation. It's what? It's 5 to 8. I don't want to keep you too much longer. I also need to have my dinner. I've had some gin and I haven't eaten, so okay, I got to eat soon, right? What I want to talk to you about is if you're a beginner, you're on a bit of a journey right now. You're in your research phase, which is the this goofy guy going, oh, I don't know what to do. You're probably reading, putting your head down and trying to learn what you need to learn. Hopefully tonight, giving you a bit of an idea as to the things that you should focus on as a beginner. But what I want to talk to you tonight is basically, oh, sorry, before I move on, is I want to talk to you about our course that we run. But once you've gone from your research phase, you'll move to your education phase where you actually start focusing on the things that you need to learn, right, in order to be a successful trader. That's where we want to help you. And the last step is obviously implementation, practice, getting good, getting experience, tweaking the rules to suit you as a personal trader, and then obviously, you know, being profitable and generating that kind of income stream that you're looking to generate or accumulate stock for that capital growth that you might be seeking, right? So it's these last two steps that where we kind of help you. And that's what I just want to briefly touch on before we finish up. So with education, you know, what you're looking for is something that's structured and something that's practical. So there's courses out there that'll give you degrees, like uni courses, obviously, that we find that they're more academic and that they don't necessarily give you the tools in order to be successful. They're great from a knowledge perspective, but to turn that into money can be a little bit harder. So you definitely want a practical approach. You want to cover the core skills and you want to be supported. That's very important. So there's two things here, core skills and support. If you're not going to be supported, make sure that you get a good education. Equally, if you're going to read a few books and watch a few webcasts, make sure that you've got like a mentor there to kind of help guide you. Preferably, you'd have both. And guess what we do, right? It's a bit of a setup. So we run our technical trading course here. It's perfect for beginners. And the focus of it is those core subjects. It's about picking direction, it's about trading strategies, and it's about risk management. What we'll do is we'll bring all that together in a step-by-step set of trading rules. So we will give you a set of trading rules that you can take to any market. We focus on the Australian market and the American market. We'll give you a set of trading rules that you can use to analyze stock or whatever you're trading. It gives you basically step 1, step 2, step 3, step 4. And if it meets all those rules, then you trade the trade, right? Later on, if you stay with us as a client, you develop a long-term relationship with us, which is what our business is built around. We'll help you develop those rules to suit you more as a trader as well, right? But in the beginning, these are the rules that we've developed over time. These are the rules that the co-founder, Carlo Castellano, that uses to this day. It's the rules that we use for a lot of our recommendations, right? So the course starts with a 2-day face-to-face training program. Now, it can be face-to-face or it can be live stream, right? COVID kind of forced, you know, a lot of this type of stuff to be done online. And it's great, right? A lot of people swear by it. You know, you can go away, have lunch, you've got access to all your materials at home. We'll send you manuals, all that type of stuff. But it's exactly like being in the classroom. You can hear the presenter's voice, you can see his face, you can see his screen, you can talk, you can ask questions, all that type of stuff. It's like being in the classroom. But you're also welcome to come into our boardroom and do it face-to-face. So we only take in 8 to 10 people, maybe a little bit more sometimes. It can be a bit of a squeeze around our boardroom table. But you come into our office, you say hello to everyone, you know, you have the office around us, you come in, and we'll cater for you, provide you with the manuals and everything like that. But the person you learn from is Carlo Castellano. He's the co-founder. He's a highly successful professional trader. He's been teaching and trading for over 25 years. He's taught locally, he's taught overseas. He's someone who's taught in America as well. He's basically retired now. He trades from home and does a few other things, but he still runs our education. So you're actually going to be learning from someone who's not only a professional trader, but someone who's also a great teacher as well, which can make the world different. Now, following that 2 days where you learn the core practical skills and Carlo's exact trading rules, following that 2 days, you actually have ongoing training, right? Now you have access to our support network. That includes access to our members website that has a whole bunch of resources for you to utilize as a beginner, who's someone who's learning, but also to utilize as a trader. So you might not want to do this education. You might just want to jump on membership. You might just want to look at some of our resources to help you with your analysis, to help you with your trading. And that's a conversation that we can have as well. But as part of our program, you get 2 months access where you get your own personal trainer. So you have your own mentor, someone that you can call up as many times a day as you like. You know, you can ask questions through email. You can ask for trading ideas. You can book appointments. You know, sometimes it can be after hours if you're really nice. We'll stay back for you. But your mentor's there to basically make sure that you're doing everything correctly, to make sure that you're not making those silly mistakes that you're prone to making as a beginner. They're your go-to guy. Now, all our mentors, I'm a mentor, by the way, so you could be working closely with me. All our mentors have many years of experience and know this stuff back to front, all right? And we've also got plenty of experience teaching this stuff, which is important. During that 2 months, we're going to be running a paper trading competition. You'll have access to trade recommendations. So if we see a trade that we like, that fits the rules that you've been taught, we'll actually send it to you. We'll say, hey, you know, Blue Scope is looking pretty bullish right now. These are the reasons why. This is the type of strategy that we reckon you could do. Here's the entry. This is where we're suggesting you take profit. If it does go down, then maybe this is where you should close out, and this is how much money you'll lose. We'll basically do all the work for you, and we'll send it to you in an email, and we'll text you as well. And you can have a quick look at it, and you'll be like, yeah, no, that makes sense. All right. And then you can just text back how many contracts you want, how many trades you want to do. You can also email us back, or you can pick up the phone and just say, you can call your trainer and say, hey, I saw there was a Blue Scope recommendation. Do you mind if we just spend 5 minutes going through that just to make sure I understand everything, that I have everything right? And that's totally fine as well. So that, and we encourage that. We encourage you to have a consistent relationship with your trainer or your advisor. And the reason why we do that is because at the end of the day, our business is built on mutual success. So if we can turn you into a successful trader, then you're more likely to continue to use our services. You're likely to maintain a long-term relationship with us. And that's what our business is built around. We find that the people who are talking to their trainers and their advisors on a regular basis, the ones who are seeking help, are the ones who end up being the most successful. I mean, who would have thought, right? So it makes complete sense. So we actually encourage you to be actively involved in the process and actively involved in your learning, and to continue and to speak to your trainer regularly. We'll also provide you daily webcasts. So every day from 12 to 1, we run a webcast for our clients. Old clients, new clients jump on. We go through the market. We look for trades. We talk about trades that we're in. You know, each of the advisors has their own kind of flair. So I run mine on a Wednesday. I focus mainly on options. My colleague Ben, he runs his on a Friday, and he focuses mainly on beginner stuff. My colleague Sam, who is like high-level genius, He focuses a little bit more on fundamentals, but obviously still mainly trading. He runs his on a Thursday. Jimmy is the most experienced advisor in the room, bar the owner of the business. He runs his on a Monday, so he's a bit of a cowboy. He has his own kind of rules and own kind of approach. And then you have Tim, who's the head of the trading desk. He's kind of like my manager, my boss. He runs his on a Tuesday, and Tim is also like fantastic, right? So you get to kind of have a different feel each day from 12 to 1, looking through the market, looking for trades, guided by an advisor. If you can't make that session, it's recorded and it's placed on the website that night, so you can view it later. You know, they're just, I don't know of any other business that does it, but they're an awesome resource as a beginner, but they're an awesome resource for when you're trading as well, because it can give you trade ideas. Like, it's for at 12 o'clock, right? So you could be having your lunch and just listening for stocks, like, oh, BHP lining up, oh, AMD's lining up, oh, okay, cool. All right, these are the stocks I'll check out after I finish my lunch, or, you know, at 3 o'clock when I feel like I do, when you want to do some trading. You know what I mean? Anyway, you can tell I'm pretty excited about the webcast. They're really cool. Now, in terms of the investment of the course, you pay a deposit of $995, and then there's just one more payment of $995. So the total cost of the course is just roughly $2,000, right? The next dates are the 2nd and 3rd of April, which is coming up fairly soon, and we only take in around, like I said, 10 people. We don't want to put too many people in, because then we can't focus on you as an individual as much as possible. Equally, we don't want to have too little people, because obviously we want to have a good dynamic in the room as well. So it's just under $2,000, $1,990 spread over 2 payments, and that includes the 2-day workshop. It includes 2 months of online training where you get your own personal trainer, you get trade suggestions, you get access to the webcast and the online training, and you get access to all the technology, so the trading platform and the calculators and things like that, right? Does that sound reasonable? Now, if you're not interested in education, that's fair enough. We've got trading services, so if you'd like to trade through us, you just want to call us up and say, hey, you know, I'm already trading, but I wouldn't mind just having some advice on the positions that I'm in. I wouldn't mind being able to execute orders on the go, get some trade ideas off you guys. You're welcome to just sign up for some membership or open up a trading account with us. Exactly like you would with ComSec. Just call us up, we'll open up a trading account with you, and you can start trading through us. And you get to talk to us on the phone, talk to me or whoever, and get some help with your trading. Okay, so that's something that's worth considering as well if you don't feel like doing some education. All right, I'm going to finish up there. I've gone a little bit over time, but so what? We've got the webcast next Thursday on the 3rd of March. Type in some stocks, right? If you want us to look at any stocks, apply what we've learned tonight through, you know, if you're in a particular position and you want some advice on it, type them in. Type them in now, and we'll have a look at them next Thursday. If you're interested in the courses, give me a call or type info into the chat, and I'll send you some information. I'll send you the recording, and you know, we can have a conversation around that as well, about the 2nd of April. Okay. All right, guys, I better run. I'm just going to leave this open for you guys to have a think about any stocks that you want, and you can just type them in. But otherwise, thanks very much for joining me tonight. Thanks for taking an hour out of your Thursday evening, which is usually a good night to go to the bar, and having to listen to what we have to say. Until next time, good luck and happy trading. Thanks, guys.